Hey everyone, and welcome to this Masterclass Explainer. Today, we're tackling an absolutely crucial part of the ACCA Financial Management exam, specifically Syllabus Area E1. We are completely deconstructing Chapter 9, Debt Finance. So, whether you're actively prepping for your exams or you just want to decode exactly how modern businesses fund their massive operations, you are in exactly the right place. Let's dive right in.
Okay, here's our quick roadmap for today's session. We'll start with the general debt landscape, then contrast short and long-term debt. After that, we'll cover the prohibition of Riba, break down 5 core Islamic finance instruments you need to know, and wrap it all up with your key exam takeaways.
All right, Section 1, the debt finance landscape. This is really the foundational pillar of everything we're about to discuss. Moving right into Section 2, let's look at short versus long-term debt, specifically focusing on corporate timelines.
You know, in the corporate world, time literally is money. What we're looking at is a stark contrast between your everyday working capital survival tools on one hand and your major growth engines on the other. Think about it. You'd never fund a 20-year factory build with a short-term overdraft, right? And you definitely don't issue corporate bonds just to pay the monthly electricity bill. Matching the term of the financing to the life of the asset is basically the golden rule in financial management.
Let's zoom in on those short-term survival tools first. These are designed to keep the lights on and manage immediate day-to-day liquidity. First up, bank overdrafts. They are super flexible, but that convenience comes at a really high interest rate. They're meant to be a buffer, not a long-term strategy. Next, you've got short-term loans, which provide predictable cash for things like seasonal inventory. And finally, trade credit. Now, trade credit is brilliant because it's essentially interest-free, supplier-funded working capital. If you negotiate 60 days to pay an invoice, you are quite literally using your supplier's money to run your business for 2 months.
Flip that around and let's look at the long-term options. These represent serious capital injections meant to fund major expansions, capital expenditures, or big long-term strategies. Corporate bonds and debentures allow companies to entirely bypass the traditional bank and raise massive amounts of capital directly from public or private debt markets. Then there's venture capital. Now, while we often associate VC with equity, it can absolutely include complex debt structures aimed at high-risk, high-reward growth funding. And let's not forget lease finance. This is a highly strategic way to secure the long-term use of an expensive asset, like a fleet of delivery vehicles or heavy machinery, without suffering the massive upfront cash drain of buying it outright.
Okay, moving to Section 3, the prohibition of Riba, which brings us to the basics of Islamic finance. So, I want you to think about this for a second. How exactly does a business raise capital if interest is strictly forbidden? In Western financial systems, interest is literally the price of money. Taking that core incentive away creates a truly fascinating structural challenge.
The whole system hinges on this concept of a riba. It's the absolute foundation upon which all Islamic financial instruments are built. See, under Sharia law, money itself has no intrinsic value. It's merely a medium of exchange. Therefore, making money purely from money, which is exactly what charging interest is considered unjust and exploitative. This strict prohibition means you need completely alternative sharia-compliant capital structures where risk and reward are actually shared.
Which leads us perfectly into Section 4, the 5 Islamic finance instruments. This is your core Sharia finance toolkit.
To really master this for your exam, the absolute best trick is to directly translate these Arabic terms into familiar Western equivalents. So, Murabaha aligns perfectly with cost-plus trade credit. Ijara matches up with lease finance. Mudaraba acts like an equity finance partnership. Sukuk is the equivalent of asset-backed debt securities, and Musharaka mirrors joint venture capital. Let's break down exactly how these operate without charging a single cent of interest.
First up, let's look at asset-based financing through Murabaha and Ijara. Remember, charging interest on a cash loan is off the table. So in a Murabba transaction, if a business needs a new machine, the bank actually steps in and buys the machine itself. The bank then immediately sells that machine to the business at an agreed-upon, fully transparent markup, and the business pays it off in installments. The profit comes from a legitimate trade of a physical asset, not from lending cash. Ijara, on the other hand, works very similarly to a standard lease. The bank buys and owns the asset, bearing all the ownership risks, and then simply leases it out to the client for a predetermined rental fee.
Next up, we have the equity and partnership models, Mudaraba and Musharaka. These are brilliantly designed around the concept of shared risk. Think of Mudaraba kind of like a sweat equity arrangement. One party, usually the bank, provides 100% of the capital. The other party provides the management and the business expertise. Profits are shared at a pre-agreed ratio, but, and here's the kicker, if there's a financial loss, the bank bears it entirely, while the entrepreneur just loses their time and effort. Musharaka is a bit different. It's a true joint venture. All partners inject capital, all partners have a say in management, and crucially, profits are shared based on an agreed ratio, while losses are strictly shared in exact proportion to the capital invested.
Finally, let's talk about debt securities, specifically Sukuk. This is arguably the most famous Islamic finance instrument globally, and it's often referred to as an Islamic bond. But remember, a traditional corporate bond is just a promise to repay a debt with interest. That's Riba, so we can't do that. To make it sharia-compliant, a Sukuk actually represents proportional ownership in a tangible asset. It's exactly why governments use Sukuks to fund massive infrastructure projects. When you buy a Sukuk, you aren't just lending money, you are buying a literal slice of a toll road or a real estate project, earning actual profits or rental income. Your returns perfectly align with the strict requirement that financial transactions must be tied to real, physical economic activity.
And that brings us to Section 5, Conclusion and Exam Takeaways.
When you're actually sitting in that exam hall or even analyzing a real-world business case, I want you to use this step-by-step mental framework. Step 1. Diagnose the timeline. Does this business need short-term liquidity just to pay suppliers, or do they need long-term capital to build a new factory? Step 2. Select the matching traditional debt instrument from that spectrum we discussed earlier. And Step 3. This is where top students really shine. Be totally prepared to pivot. If the exam scenario introduces an Islamic finance requirement, you must be able to instantly swap that traditional tool for its exact sharia-compliant equivalent. Need a lease? Pivot to Ijara. Need joint venture capital? Pivot to Musharaka. I want to leave you with one final provocative thought today. Islamic finance is currently a multi-trillion-dollar industry, and it's growing at an incredible pace. Its principles of risk sharing and asset backing are becoming increasingly attractive even outside the Islamic world. So how will the continued rise of these ethical, interest-free financial structures reshape the future of global corporate debt? Mastering these concepts isn't just about passing your ACCA E1 exam. It's really about understanding the fundamental evolution of the global economy. Keep learning, keep analyzing, and I'll see you in the next explainer.